Welcome to GRE. I'm your host, Keith Weinhold. 7 ways you can get a lower mortgage interest rate. We'll break them down. Loan types available to you that you never heard of. And learn how the 1940s GI Bill shaped the mortgage that you get today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from the Romanian Black Sea to the Egyptian Red Sea and across 188 nations worldwide. I'm Keith Weinhold, and this is the indefatigable Get Rich Education. Before we discuss the 7 ways that you can get a lower mortgage rate and more, in the 1940s, before my dad was born, the GI Bill gave veterans returning from World War II access to cheap home loans. And that single policy decision might have done more to shape the modern American housing landscape than anything else in the last 100 years. Think about it. Millions of young men, almost kids really, had just spent the better part of their early adulthood in Europe or the Pacific. They came home, married their sweethearts, started families, and suddenly America had this booming demand for housing, but demand alone doesn't build homes. You also need money. You need access to credit, and that's where the GI Bill stepped in. It didn't just thank returning service members for their sacrifice. It handed them something way more powerful: the ability to buy a home with little money down, a low interest rate, and underwriting standards that would frankly look like a fantasy today. That access to credit sparked one of the biggest housing booms in American history. You had these entire suburbs that sprang up overnight. Levittown in New York, Lakewood in California. These were master plan communities, and they really became a blueprint for post-war America. We had the booming 50s, and this had a lot to do with it. Here's the part that most people don't understand. This wasn't just about housing. This was about wealth creation, because for better or worse, homeownership has been the primary wealth-building vehicle for the American middle class these past 100 years. When you give millions of people a subsidized path into property ownership, you're not just giving them a roof, you're giving them equity, appreciation, leverage, tax benefits. You're giving them the engine, this flywheel that spins up generational wealth. In a lot of ways, the GI Bill is the earliest institutional example of what I always tell you here on the show: real estate pays 5 ways. Now, they didn't call it that in 1947, but that's exactly what it was. Veterans earned appreciation as suburbs grew. They had amortization working for them. They collected tax advantages. Inflation slowly eroded their fixed rate mortgage balances too. And here's the thing: these weren't even speculative investments. They were homes that they lived in. Now, of course, the GI Bill wasn't perfect. It expanded opportunity for millions of people, but it excluded a lot of people too. Lenders and local governments often blocked Black veterans and other minorities from accessing the same benefits. That's a whole story unto itself. But the takeaway for today is, when you combine demographic momentum with favorable financing, you can remake a nation. And that's why housing policy still matters today, which we'll get into shortly. When you change access to credit or just tweak it, you change the trajectory of families and markets for generations, and the GI Bill proved that. So when we talk about interest rates, affordability, supply shortages, or any of the high-frequency housing data that we cover here, remember that the stories aren't just about numbers. They really are about people. They're about giving ordinary Americans the chance to build wealth the same way that those World War II veterans did, through ownership, stability, and the quiet compound leverage, not compound interest, compound leverage that real estate delivers over time. I'm bringing you today's show from, I suppose, a somewhat exotic location. I am inside Caesar's Palace, which is right near the very middle of the famed Las Vegas Strip. That's where I'm at. The hotel staff is always accommodative of the show setup. This might seem a little strange to you because I'm not a gambler. The reason I'm here is that my brother lives 25 minutes away, and I've been with him during Thanksgiving. Next week, I'll bring you the show from Buffalo, New York. And then 2 weeks from now, I have something heartwarming to tell you about that. And it is a real estate story. I'll be broadcasting the show from upstate Pennsylvania. I'll be there to visit my parents. My brother's also coming in from Nevada to be there. That's where the four of us, Mom, Dad, my brother, and I, will sit around the same dining room table in the same kitchen of the same home that my parents have lived in since the 1970s. Nothing has changed. And all four of us know our spots at the table. And actually, it's not even called the dining room table. It is the supper table, as my parents call it. So from flashy Caesar's Palace today to Buffalo and then to Appalachian simplicity in Pennsylvania, the stability and continuity of my parents living in the same home and four Weinholds sitting around the table during the holidays, it is so rare. I imagine less than 1 or 2% of people can do this. I'm just profoundly grateful and proud of Kurt and Penny Weinhold for being the best, most stable parents I could have asked for. It's almost too much to ask. And if you don't have that in your life, you can do something about that. You can provide the same decency and stability for your children. Let's talk about 7 proven ways you can get a lower mortgage rate with this week's terrific guest, though we'll focus on investment properties. A lot of this applies to primary residences as well. We are joined by the founder of the lender that's created more financial freedom for real estate investors than any other mortgage originator in the nation, the eponymous Ridge Lending Group. And though that sounds impressive, my gosh, she didn't even need that introduction for you, the listener, because she's one of the most recurrent guests in show history. Welcome back to GRE, Caeli Ridge.
I am delighted to be here as always, Keith. Thank you for your support and acknowledgement. I love what you do, and I'm hoping that I can bring more value today to your listeners in what it is that we do, educating the masses, right?
You've been doing that here for about 10 years. And yes, we're talking about a woman with a reputation for writing emails in all caps, yet still maintains a great relationship with everybody. I mean, congrats, Caeli. I couldn't possibly pull that off myself.
Thank you, Keith. And, I'm going to stay by my all caps, man. It's a speed thing. It all boils down to the number of seconds in the day that I can just move quickly through an email. Yeah, I love my all caps.
Apparently, recipients are still replying. Well, you can get a lower mortgage rate in at least 7 ways. You can get an adjustable rate mortgage, do a midweek lock-in, negotiate seller credits, have a high credit score, do a 2-1 buy down, which is kind of old school, but some home builders are using it, boost your DTI, or buy now, not later. Those are some of the strategies for lowering your mortgage rate. What are your thoughts with regard to that?
I think all of those are viable. I would just say on the adjustable rate mortgage, the pushback I would give there is that for residential property, specifically single family up to 4 units, we are not finding that spread between the ARM and a 30-year fix. The industry as a whole, secondary specifically, been on an inverted yield. Now, this gets a little technical, and I won't go down that rabbit hole, but 08, 09, the housing and lending crash created an environment within secondary markets where an inverted yield has made a 30-year fixed mortgage more favorable in the rate department. Now, that's not always going to be the case. I am a huge fan of the adjustable, but what would work right now is an adjustable with the all-in-one. Not to take too much time on that topic, but that would be an adjustable rate mortgage that I think would save interest or reduce the rate of which interest is accruing.
The all-in-one loan, which we discussed extensively back at the beginning of this year here on the show. Long term, though, I have seen adjustable rate mortgages work for a lot of people because really the compelling proposition of the ARM is that it guarantees that you get a lower rate in the near term, and yet there's only a chance that you're going to have a higher rate in the long term.
And further, let's dissect that a little bit. I am a huge proponent. I love an adjustable rate mortgage when the ARM is pricing a half or a full percentage point plus over a fixed, especially for non-owner occupied. And the reason for that is, and this is statistically speaking, feel free to look this up, guys, the average shelf life of a mortgage for an investment property is about 5 years.
Great point.
Right? And we know that if that's the case, right, we're refinancing to harvest equity, we're refinancing maybe to reduce an interest rate from where the market was before, et cetera, et cetera. So that would be the first thing I would say. And then also remember, you guys, the first 10 years of an amortized mortgage, 30-year fixed amortized mortgage, how much of that payment is going to the principal? Because people will often push back by saying, well, either an interest only or an adjustable, and what happens if it changes or it goes up? Most of your payment is going to the interest anyway, and that reset to harvest equity, borrowed funds are non-taxable. We always say that, right? I think is fully justified. So I love an ARM. I just don't know in comparison to a 30-year fixed today, like a 5-year ARM versus a 30-year fixed, we are in a place that it makes sense. But normally, to your point, absolutely fan.
That spread needs to widen for the ARM to make more sense. What about doing a midweek rate lock-in? Is that a thing?
Yeah. And, I don't have any empirical evidence here. Okay. I don't have any data points that actually prove this except for 25 years in the business and locking loans every day of my life. There's something about a Monday and a Friday, and I have some conspiracy theories. I don't know that it's necessary to share them here, but midweek locks tend to be more favorable in both points and interest rate than you'll find on a Friday and a Monday. I think largely it has to do with, the stock exchanges shutting down for the weekend, right? You got a Friday, you got 2 days in between, you got foreign markets and all the things that can explode and happen during that amount of time. So I think they hedge a little bit. So on Friday going into the weekend, I think that there's something about that and why interest rates are a little less favorable. And then Monday, of course, coming off the weekend, similarly, maybe there's some truth to that too.
Now, negotiating seller credits has really been a trend to help with affordability. Tell us about specifically what you're seeing there. What's common?
So we're talking to investors. I can tell you that the loan products you guys are going to have access to are going to cap you. Okay. You're going to cap at, per guideline, 2% of the purchase price. Okay. Remember that your points that you're paying when you get into locking an interest rate are going to be calculated on the loan size. All right. So the first thing to know is seller paid closing costs maximum is going to be 2% per underwriting guidelines. That 2% is based on your purchase price. Anything that you're paying points for is going to be on the loan balance, the loan size. So there's going to be a little extra there for you that can contribute or can pay for some other closing costs, right? Depending on the numbers. Now, if you're smart enough or lucky enough or whatever, the market is viable enough that you can negotiate more than 2% from the seller to pay towards closing costs, you're going to be limited in what you can do on the loan side. But let's say that you go and you've negotiated 4%. Seller will pay 4% towards your closing costs. Then in that case, you can reduce, you got the 2 points that you're allowed per guideline, and then you can reduce the purchase price by the difference. You don't want to leave that money on the table.
That's how it's done. And then there's just simply having a higher credit score. What's the highest credit score that really helps you get the lowest mortgage rate for both primary residences and non-owner occupied properties?
Loan product type dependent, but I would say overall 760 and above is kind of that threshold. There are products that go 780, maybe even on the rare occasion 800 and above. If I had to pick a number as the absolute pinnacle, I'm going to go 780.
All right, so having a credit score above those thresholds really doesn't help get you a lower interest rate. It's really just a little flex that you've got an 811 credit score or whatever it is. Now, the 2-1 buy down, that's something that we used to see long ago. A few home builders are bringing it back. And what that does, it allows home buyers to pay a lower interest rate for the first 2 years with the seller covering the difference. And that allows the seller to get their price. They don't have to lower the price of the home at all. But the 2-1 buy down, and you see that written 2-1, that has been employed more recently. Tell us about that.
Well, the builders are struggling in some cases, right? The affordability buzzword is all over the place. So they've had to get creative and find ways in which they can move their inventory. So I think they've done a good job at kind of shaving off some of their margins to satisfy or improve the terms for the consumer. So I like the 2-1 if you can get it.
Now, one can boost their DTI as well, their debt to income ratio. And Caeli, when we've talked about that before, we've usually talked about reducing your debts in order to improve your DTI. However, a lot of people don't think about the fact that, you can increase your income. That lowers your DTI to help you qualify. So tell us, what is the max DTI that you can have?
Maximum debt to income ratio in most cases on a full doc loan is going to be 50%. Now, depending on the type of income that you earn or that you've demonstrated, how you calculate that can get a little bit tricky. But if you're just a straight W-2 wage earner, we don't have, commissions or bonuses or anything that we consider variable income, then you just take your gross income times 50%, whatever that number is, all of your liabilities on the credit report. We do not count ordinary living expenses like food and gas and utilities and cell phone bills. It's the minimum payments on the credit report. As long as whatever that add up is fits within that 50%, you're good to go.
Now, when it comes to improving our DTI to get a lower mortgage rate, I tend to think it's easier to knock out some debts to improve your DTI. But what about the other side of it? What about increasing your income to improve your DTI, lower your mortgage rate, and qualify? Can you talk about some of the strategies for increasing your income with respect to DTI?
Absolutely. And the biggest one I think that we probably want to focus on most is going to be on a Schedule E, right? That's the one that you're going to have more control over. So when we talk about rental income and how we might be able to boost that, first, it might be important to share that there are 2 ways in underwriting that we will calculate or quantify rental income. The first way is called the acquisition year formula. I'll give you that in just a second. It's very easy. But the way I think we focus on here, because acquisition year is going to be what it is, you're going to have very little ability to manipulate or change that. Once our rental properties fall on our tax return, specifically the Schedule E of a federal tax return, you as the taxpayer or the borrower are going to have some access to maximize or increase the income, or let's actually get a little bit more granular there, to maximize the gain or minimize the loss by means of depreciation, maybe a cost seg. Maybe we make sure that one-time extraordinary expenses are demonstrated on the tax return in the appropriate way so that underwriting can add those things back. So I know that this sounds technical, but the Schedule E is the way that I would say is the easiest for an investor to maximize income, reduce debt to income ratio. And I will close by saying that Ridge Lending, I think one of our most valued value adds is the ability to help our clients look at their draft tax returns on an annual basis and present them with, hey, listen, Mr. Jones, if you file this way, this draft tax return, if it files this way, this is what it means to your debt to income ratio. Here's my advice, right? We go into a lot of depth there with our clients.
That is a smart long-term planning piece that most mortgage companies are not going to give you. They're not going to be forward-looking, looking out for your next 3 years of growing your income property portfolio. And shortly, we'll talk about a way for you to qualify loans where you don't have to show tax returns or W-2s or pay stubs. But while we're talking about how to get a lower mortgage rate and some creative ways to do that, I brought up buy now, not later. And what do I mean by that? What I mean is, say properties appreciate even 3% over time. Buying now, that is going to net you more equity if you buy now rather than waiting than it would in the savings from a rate drop when you look at the appreciation run up. However, if rates go up, then you get both the lower price and the lower rate by buying now, not later.
And I would add to that, we have to remember that in addition to a very modest 3% in the home appreciation, we should be appreciating our rents at even a modest 2% a year, right? Depending on where you are, et cetera. I know that there's exceptions to the rule. And then finally, we got to add in that tax benefit, what you're going to get in your deductions, et cetera, et cetera.
Yeah, great point. Well, I brought up 7 ways that you can get a lower mortgage rate. Can you share a few more with us, some common ones? Because I know that almost everyone that calls in there wants to inquire about mortgage rate as well.
Everybody wants to talk about the rate, despite my fervent opposition to say, do the math, do the math, do the math. The easiest one there would be buying down the rate. I'm going to try and formulate an example. Let's say you've got a really high wage earner and in the thick of their earning years, and they're trying to prepare for retirement down the road. It's a longer term burn. They desperately need tax deductions. And the deal that they're looking at, yeah, it's okay, but they want some extra expenses on the Schedule E. Maybe they buy the rate down by 3, even 4%, because points on an investment loan transaction are tax deductible. So that might be something, and they obviously benefit from the lower interest rate. Now, I may push back on this, and I think, again, I know I sound like a broken record here, but we really need to do the math. What are we getting versus what are we giving up to get a 6% or 5.5% interest rate? What does that mean in real tangible cost, and what's that break even? It's actually a fairly simple calculation when you just divide the difference in what you're getting versus what you're paying for. And that'll give you the number of months that it takes to recapture the incentive versus the expense. But that would be the easiest one, Keith. I would say buying down points, paying additional points to get that lower interest rate.
Buying down your rate, it can feel good in the short term, but it's often not the best long-term or even intermediate term move when you do the math, as you always like to say. Well, you, the listener here, you know that you can qualify for mortgage loans for rental properties without needing a W-2, without needing a pay stub, and without even needing to show tax returns, because you need all those things for a conventional loan. But for a DSCR loan, debt service coverage ratio, you don't. So talk to us about the pros and cons of a DSCR loan versus a conventional loan.
Okay, and I've got a hook here too, because I think the listeners are going to be very, very pleased to hear at the end of this statement what's happening with DSCR in conjunction or comparison rather to the conventional. So DSCR, everybody, means debt service coverage ratio. It's a very simple formula. We are going to take the gross rents and divide it by the principal and interest and taxes and insurance and association if it applies. That's it.
$1,000 in gross rents, $800 in PITI, that yields a DSCR of 1.25.
Correct. Yes, you're absolutely right. The one that I use just to keep it simple is 1,000 rents, 1,000 PITI. That's a 1.0, right? As long as the gross rents are equal or greater than the PITI, you're going to be in a position to get the more favorable rates. Now, that's not to say that we can't go below a 1.0 ratio. You can actually have a property. We have products that will allow the DSCR to be a 0.75. That would mean, in this scenario, if you had gross rents of $750 and the PITI was $1,000, you can actually get that loan done. That is allowed. The rate gets a little bit hairy. So more often than not, we're at the 1.0 and above. So this is just a really great way for investors who are either recently self-employed, maybe they're adjusted gross, they just write everything off for reasons that you can imagine why, right? They don't want to pay the taxes. It could be 100 different reasons. The DSCR option is such a great solution to provide a 30-year fixed mortgage, same, similar leverage, if not sometimes even better than a Fannie Freddie, than a conventional loan. You can usually leverage a little bit more in some cases on a DSCR, like a 2-to-4, for example, 2-to-4 unit residential property Fannie Freddie. They kind of cut those loan to values a little bit, and the DSCR loans don't care about that. So you can get the same leverage as a single family would in a DSCR. The only other primary difference is these DSCR loans are going to come with prepayment penalties. Typically, the standard is about 3 years, but we're usually not refinancing in the first 36 months anyway. If you know that that's applicable to you, then you'd have to buy the prepay down or out, which you can do. Otherwise, DSCR is amazing. Oh, and I'll give you the little hook here. So something I have observed, this is maybe very recent, 45, 50-ish days, the margin for interest rate difference between conventional and DSCR is really starting to narrow. DSCR products are really performing well, and that interest rate improvements that we've been seeing for those products is not far off from what the Fannie Freddies are. And I've even seen examples where DSCR beats a 30-year fixed Fannie Freddie rate. Now, those are for the higher loan amounts. I can explain if you want, but otherwise, that's good news.
Okay, this is really good news. It's a time in the cycle where DSCRs could very well make sense for you without that huge documentation shakedown that you need with W-2s and pay stubs and everything else. There are a lot of nascent trends in the mortgage industry, and we're trying to separate some of them from being rumors, from being something that can truly happen. We're talking about 50-year mortgages and portable mortgages. More on that when we come back. You're listening to Get Rich Education. Our guest is Ridge Lending Group President, Caeli Ridge. You know, most people think they're playing it safe with their liquid money, but they're actually losing. Savings accounts and bonds don't keep up when true inflation eats 6 or 7% of your wealth every single year. I invest my liquidity with FFI, Freedom Family Investments, in their flagship program. Why? Fixed 10 to 12% returns have been predictable and paid quarterly. There's real-world security backed by needs-based real estate like affordable housing, senior living, and healthcare. Ask about the Freedom Flagship program when you speak to a Freedom coach there. And that's just one part of their family of products. They've got workshops, webinars, and seminars designed to educate you before you invest. Start with as little as $25K and finally get your money working as hard as you do. Get started at freedomfamilyinvestments.com/GRE or send a text now. It's 1-937-795-8989. Yep, text their Freedom Coach directly. Again, 1-937-795-8989. The same place where I get my own mortgage loans is where you can get yours, Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Caeli Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com.
This is Hemlane's co-founder, Dana Dunford. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Ridge Lending Group President and founder, Caeli Ridge, about how you can get lower mortgage rates and also about some trends in the industry, separating what's really a rumor and what could really happen, squaring on 50-year mortgages and portable mortgages. Those are both things only being discussed by the administration to help with affordability. FHFA Director Bill Pulte created some jarring news recently when he publicized this. What are your thoughts on the 50-year mortgage?
You know, on a primary residence basis, I'm not so sure. I need to maybe put some more thought into that. But for an investment property, I love it, man. Anything to keep that payment down so that, because remember, we talked about earlier in the show here, the percentage of mortgages, let's just use our 30-year fix for a second, that for a rental property that start on day one and then stroke a check 360 times later to pay that to zero is a fraction of a percent, right? We are refinancing these things. We are selling them and doing 1031 exchanges. So anything that can keep my cash flow higher and my payment lower, I am all for it. Now, the people that push back and say, well, I want to pay off my mortgage in 15 years. I don't want to pay extra interest. You are welcome to do that. So there's a second piece to this that I think is equally as important as maximizing cash flow, and that is your qualification. All right. If this comes to pass, and right now it could just be noise. Okay. And I'm speaking specifically for investment property. But if this is available to us, the debt to income ratio component, because think about it like this. So I'm going to keep using my 15-year and my 30-year because that's kind of what we understand. The payment difference between a 30-year 360-month and a 15-year 180-month can be substantial depending on the loan size. I mean, it can be hundreds and hundreds of dollars. For the individual that is dead set and say, I don't want to pay the higher interest, I want to pay these things off. We may have arguments about that whole strategy to begin with, but overall, if they still want to do that and that's their decision, fine. Take the 30-year fixed payment, take the 30-year fixed mortgage, apply the difference. You can figure out that payment difference very easily. Apply it religiously every month. You will cross the finish line in about 15.4 years. Download an amortization calculator online. You can find them everywhere. Plug in your numbers and you'll see what I'm talking about. If you were to do this, let's say the difference is $200 a month and you send it in every month with your 30-year fixed mortgage payment, you will cross the finish line to pay that thing off in about 15.4 years. So yes, you'll pay a few extra months of interest, but what have you done to your qualifications? Right? Your payment now on your debt to income ratio, when we're looking at this thing for future optimization, never take the shorter term amortization ever, ever, ever. You won't pay the higher interest that the 30-year or the 50-year will probably come with because you've accelerated the payoff so long, if that's your choice. Now, for everybody else that really wants to maximize that cash flow and they get that they're going to be refinancing this every 5, 6, whatever it is years, take it, man. I am all for the longer term amortization on a rental.
I agree with you. I even like the 50-year on a primary residence. But yeah, Caeli, right here on the show, several weeks before Bill Pulte made the announcement, I actually talked about the 50-year mortgage and compared it to the 30 and the reasons that I like it, because I knew there was a chance it could be coming since this administration is trying to do so much to help out with affordability. People buy based on a payment, not a price. That lowers the payment. A 50-year mortgage helps you benefit from inflation, and there are a lot of other advantages that have to do with that, although you probably are going to pay a higher interest rate on a 50 than you would a 30. And you know, Caeli, when the 30-year mortgage had its advent just after World War II, I'm going to guess 75 years ago, people were having this same conversation like, oh, 30 years, my gosh, you're never going to pay off the home. And really, that's not what it's about.
Not at all. Not at all. And remember, you guys, I would encourage everybody listening to this to actually go get that amortization table and see how much interest is baked in and how it is applied and paid. It is the back end of any of these amortized mortgages where the principal actually starts to get applied in a meaningful way. The 50-year mortgage or the longer term amortization is a huge advantage. I'm speaking for investors mostly. I love it.
Some people say, are you nuts? Look at how much more interest you're paying over the life of the loan on a 50-year mortgage versus a 30-year mortgage. We already touched on that you're not going to keep that loan for the life of it. And if you just take the difference from the lower payment that a 50-year gives you and invest that in an 8% return, you are going to crush 2x to 3x oftentimes what the paltry interest savings are over several decades.
And somebody else is making that payment, right? We have tenants that are responsible.
100%. And then there's something that I don't know if portable mortgages would fly. And what this means is that when borrowers move, they could keep their rate, keep their term, and keep their lender, presumably, for the new home. You might have seen it in the news, you, the listener, that Fannie Mae removed the minimum credit score requirements from desktop underwriting. And Caeli, I think you let me know elsewhere that those changes don't affect non-owner occupied, but of course it could affect the broader housing market in pricing. What are your thoughts about lowering the credit score requirement?
So similar to the portable stuff, until it really reaches mainstream and it affects the non-owner occupied, I'm not deep diving into those things. The basis of it, though, is that, yeah, they're removing that minimum credit score requirement from a DU underwrite. That stands for desktop underwriter, as you said. That is Fannie Mae's sophisticated automated underwriting system. And I think it's just going to give more eligibility to lower income households and people trying to become homeowners that have found the barrier for entry very restrictive because they have credit issues.
Well, let's talk about FHA and VA loans, something that we have rarely, if ever, touched on. Our listeners know that I started out making my first ever property of any kind, an FHA loan with 3.5% down on a fourplex, living in one unit, renting out the other three. Tell us about some trends there in FHA and VA loans.
We actually just did House Hack campaign. We did a webinar on it, co-living, all those different ways in which, the younger generation especially, and this is true for anyone, I don't want to pigeonhole it, can get themselves into home ownership and propel them into the real estate investing as an asset class. I am such a big fan of this model and this strategy for anybody that's interested and willing to kind of co-mingle or habitate. Like you did, a fourplex at 3.5% down. You've got 3 tenants that are making your mortgage payment. VA, likewise, any of the Govy loans, which include VA, FHA, USDA, you can get high leverage and up to 4 units. So I'm a huge fan of that. And then the co-living is another thing that I think is not quite mainstream, but I think it's gaining steam.
For those that don't know what we're talking about, you can use an FHA loan with a 3.5% down payment as long as you live in one of the units. Your credit score can even be pretty low, and you can do that with a single-family home, duplex, triplex, or fourplex. You can get those same benefits with the VA loan and 0 down.
USDA also 0 down if you're in the right zip code.
How does one qualify for a USDA loan?
There's a website I would have you check out. We don't do a ton of those. We have the ability, of course, but there's income restrictions and all of this. They've got actually a pretty slick website where you can go online, type in the zip code, make sure it's in a rural area, what your income is. There's all these inputs, and it'll tell you if you'd be a candidate for it. But yeah, it's good rates, zero down. I like the product.
Well, there have been a lot of newsy items when it comes to mortgages, Caeli, and I think we should drop back before we're done here and talk about the basics. Just basically, what does it take to get a non-owner occupied loan for residential income property?
There's so many options for investors today that I would say that if you have access to, and even with what we just said, house hack, I mean, listen, if you've got 3% down, 3.5% down, you can probably assure yourself you can get into a property. And if you can't qualify from a debt to income ratio perspective, you've got 3 or 4 other models, which include DSCR, bank statement loans, asset depletion loans. Overall, I would say that this is an individual conversation. Chances are you could probably qualify today. And if you can't, one of the things that I love about Ridge Lending is that we're going to help you plant the seeds and show you how to qualify. If it takes you 3 months or 6 months or a year, that's what we do.
Yeah, we've definitely noticed the difference here, and that you do help that investor with long-term planning. I do my own loans at Ridge, and my assistant here at GRE, she recently got the ball rolling with you in there at Ridge as well.
Brenda, yes, that was fantastic. We are very looking forward to helping her.
Well, Caeli, I've come here with a lot of questions that I had. What's the question no one's asking you, but you wish that they would?
I think it probably would be for me planning. We get a lot of questions about interest rates. That's kind of top of mind for everybody. More about planning, having people that are interested in real estate as an asset class and an investment, have the conversations to say, this is where I'm at today. This is where I'd like to be in 5 years. Tell me how to get there. And we can have those high level conversations that really sort of reverse engineer it and say, okay, this is where you stand today from an underwriting perspective. This is where you need to be. And here's how we're going to get you there. It's always about planting seeds and creating those roadmaps, as I like to say. So I would say that would be top of my list.
That's exactly what you do in there. And that's really what sets you apart. Well, remind our audience how they can get a hold of Ridge.
Yes, there's a couple ways, of course. Our website, ridgelendinggroup.com. Please email us, info@ridgelendinggroup.com. And then call us toll free, 855-747-4343. 855-74-RIDGE is an easy way to remember.
It's really been valuable this time, Caeli. Thanks so much for coming back onto the show.
Appreciate you, Keith.
Oh yeah, good pointed info from Caeli over at Ridge. I think that the important things for you to remember from our conversation is that, gosh, isn't it so glaring, like in your face, that you have options? All these options. When you engage with a lender, you're going to learn that there are probably loan programs that you've never even heard of, some that you might fit into. And even if you aren't adding more property, if you're not in that phase, there are ways that you can take your existing loans and consolidate them or refinance them or use them to produce a tax-free windfall for yourself. And the U.S. is often the envy of other world nations with the flexibility that we have here in our mortgage market. I've never known anyone that does this better than Caeli and her team. I mean, they are real difference makers. If you learn something on today's show, hey, don't hoard the good stuff. Engage in the nicest kind of wealth redistribution. Tap the share button right now and share this on social, or text this episode to one friend who'd appreciate it. That would mean the world to me. I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.